This is a BC Eagle Finance video. Brigham and Houston, Chapter 2, Section 5, Efficient Market Theory. In today's investment setting, markets are said to be efficient. That means that for all intents and purposes, with the computer access to market information, securities are normally in what they're called a state of equilibrium, meaning that they are fairly priced, because those wanting to supply money at a certain price will just about always equal those willing to pay that price to have access to their money. So what that means for individual investors like you and me and the person down the street is that we really cannot beat the market except through dumb luck, or if we have some super inside information which is patently illegal. So what is an investor to do? Well, let's take a look at the continuum of market efficiency. For the major stock exchanges like the New York Stock Exchange and the NASDAQ exchanges, there are some very large companies on these exchanges. The information flows freely and very rapidly through the internet. And so these markets are highly efficient. If there are any pricing differences anywhere in the world, they can be exploited not in seconds, but in tenths of seconds with the highly computerized trading that goes on in the exchanges. Where you might find some opportunities is with the small companies that are not followed by the big investment houses. Their information is not as widely distributed, and if you happen to be in a regional area and are able to watch some signs of that company grow, you may be able to get in on some inefficient information. But in general, we cannot beat the market. We as investors must accept the market return and develop another strategy in order to protect our returns. So, what are those implications? Well, let's take an example. Let's suppose that you hear news that a medical research company has just received FDA approval for one of its new products. This would be a drug. And if the market that this company trades in is highly efficient, can you expect to take advantage of this information before other investors do by buying the stock? Well, the sad news is no. Companies are not allowed to disclose insider information, and all information must be released to the public at the same time. This means that when this company has approval for the FDA, it will announce this information to all investors and not give a whisper to just certain investors that might be close to the company. So by the time you hear it, the information is already too old to make a profit on it. That's bad news. So what can we do as investors? Well, our strategy isn't to try to time the market or to try to buy the stock before others do. It's to diversify our holdings among different assets classes. Now, this happens according to our own physical age. Folks in the 20s, like yourselves, could take on more risky type stocks, those that are in their growth stage and pay less dividends. Folks that are closer to retirement need to be more conservative in their portfolios and buy more dividend-paying stocks and to protect the returns that they have earned over the lifetime. So here are the various asset classes, very broad brush on this, of where investors can put their money. As we mentioned, those in their early 20s and probably through their 40s can invest in growth mutual funds, those stocks that are in the growth phase of their product life cycle. There is also the S&P Goldman Sachs Composite Index of the top 500 stocks in the stock market. There's also the Europe, Asia, and Far East Index, which is an international index. And for those of you that like real estate Investment Trust Index is available for that. Also, for the conservative investors, those that are in their 50s and 60s, or those that will need money within the next 5 to 7 years, there are bond indexes that take a conservative view to protect principal in addition to earning a little bit of extra income. Now, a detailed discussion of this information is beyond the scope of a finance course, but come every even-numbered fall, Bridgewater offers an investments class that gets a little bit deeper into the specifics of this particular asset strategy. Let's take an example of market efficiency. Let's suppose a small investor has done some reading over the internet, so it's brand new news today, that a company is going to issue its shares, a hot IPO stock that is going to go public in a few days. The investor wants to buy as many shares as she can to get a head start and is planning on buying a lot of the shares the first day once the stock begins trading. Does this sound like a good idea? Well, as you can guess, maybe not. For a couple of reasons. Number one, the long-term track record of IPOs is really not that great. After the initial day or two of enthusiasm, IPO stocks actually decrease in their value for up to 6 to 7 months before they retain their initial IPO price again. So buying hot IPO stocks is not a good short-term, or for that matter, even a long-term investment strategy. And a second reason is very practical. The investment syndicates during the IPO does not like to sell to you or me or the person down the street that will only buy 5 or 10 shares. They want to sell to institutional investors that will buy 10,000 share blocks. So if an institutional investor wants to buy 10 blocks of a particular IPO, they are going to buy 100,000 shares. Those investors are the ones that get on the IPO floor on the first day. So it's very difficult for small investors to buy IPO shares. Most small investors wait until the IPO investor wants to get its gain and sell the shares in the secondary market. Let's move on to the final topic, why markets may not be all that efficient. It's nothing we can do about it, but we might recognize that sometimes they may not be efficient. First, it's very costly or risky for traders to take advantage of mispriced securities. For example, let's say that you saw Apple stock trading on the New York Stock Exchange for $168.17, and that over in Europe, that same Apple stock is trading for $170. Well, for the few cents spread, it might cost you transaction costs, broker's fees, in excess of that particular spread. So it's costly. Also, if you're buying in the European market, it's a different market than you're used to, and you may not be able to get clear title to the shares, or there might be some disconnect in transferring the shares to you in the United States. So there is risk in taking advantage of the market inefficiencies that you see. At best, they are small. Transaction costs oftentimes exceed that disparity. More importantly, and probably a bigger reason, would be the cognitive biases that we as humans have. We're hardwired this way, and psychologists will spend a lot of time defining this particular type of bias that we have. This is a whole range of study that you can get into called behavioral science, and it does borrow its insights from psychology to describe how we as humans oftentimes act irrationally despite having rational information. And as the picture indicates, there is a herding instinct where we all follow the crowd. We don't want to be out there on our own. Humans have a loss aversion, meaning that we feel the pain of a loss to a greater extent than the exuberation of a gain. We also take a mental accounting. Geez, are we really doing this right? Are we thinking straight, or are we just dreaming pie in the sky type thing? There's a buyer's regret, or there's overconfidence. And we as humans get distracted a lot, so we may not pay attention long enough to make good decisions. And then, instead of doing analyses, we do have rules of thumb that we tend to follow blindly, even though they might not produce the best results. So, human behavior may create inefficiencies in the market. Some examples: our risks as humans are evaluated differently in up markets compared to down markets. And also, if we've had a track record of being right, well, we may believe that being right is more for our ability or due to our ability rather than just plain luck. For example, the overconfidence issue may come about. Let's say that we are buying shares of stocks in 7 different companies, and we have picked 7 winners in a row. And we think we've gotten pretty good at this. Well, let's say that those 7 stocks each had a 50-50% chance of being right, just like flipping a coin, 50% heads, 50% tails. You know, we can get a string of 7 heads or 7 tails more often than we think, but that happens purely by random chance. Not because we're good at guessing, not because we have particular insight, but just because of the random process. The overconfidence that a string of successes in a random process gives us can lead us to bad investment decisions. Instead of recognizing that each chance that we take has a 50% of failure, we may look at our previous track record and say that we are a lot better than we truly are. In evaluating the risks in up markets compared to down markets, and the fact that humans are risk averse, they feel the pain of loss more extensively than the elation of success, let's take a look at NFL coaches. This is an example from the New York Times article a few years ago about actions of NFL coaches on 4th down and short yardage. If the statistics type would go back and review 4th down conversions for 4th and 1, 4th and 2, and various yards to go, this is the chance of success compared to punting, compared to a field goal. And as you can see, if a football team is on 4th down with less than 2 yards to go, just about a little bit better than 70% of the time, they are going to be successful in getting a first down on 4th and short yardage. Despite these statistics, NFL coaches are a conservative bunch by nature. Even though coaches have statistics that indicate their rates of success are much higher, they are very conservative and will work to avoid losses rather than work to have gains. Investors are the same way. We feel a whole lot more pain when we lose what we've already gained than the chance of getting more when the opportunity presents itself. Now, your turn to lock in the learning by responding to these questions. What does it mean for a market to be considered efficient? Is the market for all stocks equally efficient? And can you give an example of where this may or may not be? Why is it good for the economy that markets are efficient? Is it possible that the market for individual stocks can be highly efficient, but the market for the whole set of companies could be less efficient? Can you explain why that is or is not the case? Finally, what is behavioral finance, and what are the implications of behavioral finance for market efficiency? This is the end of Chapter 2. Thank you for listening.